Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 1249A, and today's date is April 7th, 2017, and the title of the episode is The Economic Data Just Went From Bad to Worse. The Collapse Accelerates. Let's get into the economic collapse financial news. Now, we've been talking a lot about the collapse of the system. We've been talking a lot about war, and we've talked about how things can change so quickly. And what we're seeing right now is how quickly things can actually change. 1 minute, there are people out there who had hope. People out there saying that, yes, this is going to be a lot better. Jobs are going to be coming back. Manufacturing jobs are going to be coming back. And everything looks fantastic. And then one day, something happens and things change in a split second. And this is what we've been talking about all along. All the people out there who don't believe that this is going to happen, who believe whatever they want to believe, it doesn't really matter. Because you need to look at the patterns. You need to look at the indicators. You need to look at how these individuals operate. And I'm talking about the deep state. I'm talking about the central bankers. I'm talking about all these individuals. And the patterns and what they do is always the same. Things might not happen right on target, but they're going to happen. I mean, think about it. Just in February, one of the reports that I put out there, that I said there was going to be another event coming. And we are seeing this huge, huge event. Now, was it an event here in the United States? No, not yet. But there was an event that caused us to do something, and everything changed in a split second. Well, we're seeing the same thing in the economy. We're seeing the same change. And things can change in a split second. It doesn't take that long. And you need to understand this, that 1 minute you can be going outside, it's sunny, you see the beautiful trees, spring is coming, you see the buds on the trees, and you think, wow, life is great, look how nice. I can't believe the economy is collapsing. I can't believe that we might go to war. I can't believe any of that stuff, because look, I can see outside that everything is fine. But just like with a storm or anything else, 1 minute, it's beautiful. The next minute, it's raining, flooding, there's lightning, there's wind, there's damage, and it's the same with a collapse. It's the same with war. It happens in a split second. Well, not really, because what happens is there's a huge buildup. You can see it being created. You can see it happening until that point where everything starts to fall apart. And this is what we've been looking at. We've been looking at all the things that make up a collapse, all the things that make up a war. And we're seeing it today, and we're getting to that point where you're going to snap your finger and things are going to change. Your life is going to change. The world is going to change. And the jobs are not coming back to America as of yet. Manufacturing is not coming back to America as of yet. We are still in this collapse scenario. And we can see right now that the information that's coming out, and the BLS just put out information, and compared to the ADP report, we can see that, well, they've gone in two opposite directions. The BLS confirmed that something snapped in March when only 98,000 jobs were added, roughly half of the 180,000 expected. This was the lowest monthly job numbers since 2016. And what we're looking at right now is a decline. And the unemployment rate, because of this, scratch your head, came down to 4.5%. It was at 4.7%. So again, does that sound right to you? No. So what happened? Well, things started to rapidly fall apart. And I just wanted to go and talk about retail for a second and how bad retail is, because we're seeing all these economic indicators, and they're going from bad to worse now. The retail sector right now slashed 30,000 jobs in March. This is coming from the BLS on Friday. That brings the total number of jobs lost in retail, and we're not finished yet, because remember, there's going to be about 3,500 stores closing. So the number of jobs lost in March and February is around 61,000 jobs in retail. In March, employment in general merchandise stores declined by 35,000. The BLS said employment in general merchandise has fallen by 89,000 jobs since its most recent high in October. Retail leads all sectors this year with 38,464 announced cuts, 4,000 of which occurred in March. Points of outplacement consultancy Challenger Gray and Christmas confirm this. First quarter retail job cuts are 19% higher than the 31,000 cuts in the same period of last year. So when we look at this, we can see that things have gotten worse. And these stores, the rest of the stores, they haven't even closed down yet. This is a disaster in the making. And it's getting worse. The UK's Telegraph just published an analysis of global debt, and it sums up the crisis completely. Here's what they said. Global debt was climbed at an eye-watering pace over the past decade, soaring to a fresh high of $170 trillion last year, according to the Institute of International Finance. The IIF said total debt levels, including household, government, and corporate debt, climbed by more than $70 trillion over the last 10 years to a record $215 trillion in 2016. I mean, that's 325% of global gross domestic product. What's happening here is we have this debt bomb, and this debt bomb is about to go off. And they're warning us, saying that this debt cannot be sustained. And what is happening is we're continually putting on more debt. This tells us right now that things are rapidly falling apart, and they're telling you right now they're noticing, and there's no way to avoid it anymore. We have to report on it because people are bringing it up, and there's no end in sight. Japan just passed a record high government budget, 35% of which will be borrowed. The U.S. added $1.3 trillion to its federal debt in 2016 and is debating a massive increase in defense and infrastructure spending. China's corporate debt alone exceeds 170% of GDP, which leads to three inescapable conclusions. Interest rates can never rise because rolling over this much debt with historically normal rates would blow up the budgets of both the developed and developing worlds. The only solution right now, if you can call it that, is a massive currency devaluation to make these debts manageable. What does that mean? If they devalue the dollar, that's inflation. It's going to cost you a lot more of those pieces of paper to purchase your goods. And that's what we're going to see here. We already see the Atlanta Fed. They have lowered now, and this is an estimate. They're predicting from all their data that GDP now is at 0.6%. And this is the manipulated number, which means the real GDP is in negative territory. And we know that treasuries around the world are being dumped. I mean, listen to this. From 1776 through 2007, the U.S. issued just over $9 trillion in U.S. Treasury debt to pay for stuff which we wanted, but we were unwilling to tax ourselves to pay for. The majority buyer of this debt was the intra-government surplus funds, primarily Social Security. You know, all that money you put into Social Security? These funds were mandated to buy governmental accounting series non-marketable debt. The remainder of the issuance and holding were fairly evenly split between foreigners and domestic buyers, with a minor portion of primarily short-term notes and bills held by the Federal Reserve. From 2008 to 2014, the U.S. Treasury nearly issued as much debt as it had in the previous 230 years, but the proportions bought and held by these creditors significantly changed. The intra-governmental surplus funds were dwindling Social Security, so the buyer of nearly half of all the Treasury debt up to that point took a back seat, buying only 8% of the new issuance. No surprise, it was the Federal Reserve that stepped in, and foreigners who bought the rest. Now, since QE ended in late 2014, well, we know it's covertly happening in the background. The makeup of the new buyers, holders of the U.S. Treasury debt, is completely different. The Federal Reserve has purchased nothing since the Fed ceased buying. And everyone's saying, whoa, no, that's not true. Hold on. Foreigners have sworn off the U.S. Treasury debt and sold $200 billion. So the only buyers for the continuing issuance And the portion not rolled over by foreigners is the domestic public. Now, this is where it gets a little interesting. So the question is, who among the domestic public is buying all those still near record low yielding treasuries? According to the latest Treasury bulletin, well, we found our answer. And it's clear as day. Not really. It's called other investors. So you say, well, who are the other investors? Who are these primary buyers? Interestingly, the other category has nearly doubled since 2014 from less than $1 trillion to $1.8 trillion. So the Treasury market is supported by other investors, which unfortunately the Treasury bulletin provides no more detail about. That's very interesting. But other is the primary within the intra-governmental surplus, again coming from the Treasury. So we can see that most likely it's coming from the Treasury. And this is a main problem because the Treasuries were normally sold to countries. And now the United States, not even the Federal Reserve, they're buying the Treasuries? I mean, think about what's happening right now. It's a complete disaster. And this whole thing gets even worse because we know that the market is not going to stay up. We know it's manipulated. It's not based on anything. And traders now are selling insurance to protect against volatility using a feedback loop theory. Now, if they do this and there's a shock in the system and the system collapses, this is a terrible scenario because all those who are supplying the insurance, guess what happens? They're going out of business. They're not going to be able to pay up. People can pretend that the insurance is there, and it's almost like the FDIC. When the system implodes, the FDIC doesn't have enough funds to cover all the banks. The banks have no funds. That's why they created the bail-in documents. So we see what's happening right now. This entire system, from everywhere we look, cannot be sustained. And it's going to change with a snap of a finger, just like we're seeing everything else change now. So get prepared, be ready, because it could happen at a moment's notice. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.